Welcome back, Adam here, and today I'm looking at 20 different expenses that a landlord may be able to claim when calculating their rental profits. And I'm also going to explain how mortgage interest works for landlords. So if you own a rental property, then this video will be useful for you. The phrase that HMRC used to determine if an expense is allowable or not is wholly and exclusively. So providing a purchase is wholly and exclusively for the purposes of letting your property, then it should be allowable. The great thing about trying to determine what's allowable and what isn't for rental properties is that there are plenty of other landlords out there who essentially are running almost identical businesses to you, so it's going to be the same expenses that come up again and again. Let's take a look at some of the most common examples. The first big category of expenditure that landlords will incur are repairs and renewals. Now, this is an important one to understand because you'll need to be able to distinguish between expenses which are repairs and renewals and those which are capital improvements. Repairs and renewals will usually replace something like for like and are allowable expenses, whereas a capital improvement will change the property in some way which can significantly impact its value, and these are not allowable for the purposes of calculating your rental profits, although they would usually be considered allowable when you come to calculate your capital gain or loss on disposal. So, replacing windows are a great example of this. If a window is damaged in some way, possibly by a tenant or in a storm, then replacing it would usually be fully allowable for the landlord, as that would be considered a repair. If the landlord decides to upgrade their windows from single glazing to modern double glazed window frames, then this may be considered capital in nature, and where that is the case, it would not be allowable. Replacing broken or damaged roof tiles and guttering are another example of repairs and renewals that would be allowable. Adjusting the roof to include some skylights would usually be capital in nature and therefore not allowable. A new bathroom may well be deductible, even where it requires some fairly major work in ripping out the old bathroom and upgrading to more modern fittings. Providing the bathroom is being replaced like for like, the expenses can be claimed. A situation where you are creating a new bathroom that didn't exist before, maybe adding an ensuite to a bedroom, would be considered capital expenditure and therefore not allowable. Hopefully those examples of revenue versus capital expenditure will help to clarify the difference. Some additional repair items might include boiler repairs or even a boiler replacement. A simple service or a call out can be offset against income, as can replacing the boiler like for like if it were to completely break down on you or your tenant. Paying to have water and gas leaks fixed, repointing brickwork, treating damp problems, and redecorating would all be allowable examples of repairs and renewals. Next up, we've got utilities and household bills, which are another category of expense that will be common for landlords. It may depend on the type of agreement that you have with your tenants, whether the landlord pays these bills up front or whether the tenant is responsible, but every landlord will pay them to some extent, as a property is rarely let 100% of the time. Insurance is allowable, but just note you will usually need a specialist policy for landlords. Your typical home insurance policy isn't sufficient, and mortgage lenders will usually insist on seeing your landlord's insurance policy to make sure it is in place before they lend to you. Rent guarantee insurance is another allowable expense that plugs income gaps where a tenant fails to pay. General utilities such as electricity, water and gas are all allowable, of course only where the landlord is actually incurring these costs and paying the bills. If it's the tenant that's footing the bill, then you won't be able to deduct these costs. Council tax paid by the landlord can also be claimed, as can gardening and cleaning costs. This could be regular cleaning services that are provided. It could be deep cleans at the end of a tenancy. Just remember though, if you are claiming the cost of cleaning but recharging this to the tenant or deducting it from a rental deposit, then you would also need to declare the income to make sure that it offsets, as technically you haven't actually suffered that cost, the tenant has. Gardening expenses could be a regular service provided by a third party, or it could be your green bin license to remove garden waste. Both would be allowable, providing the waste being removed is coming from the property. Now I'm going to move on to admin related expenses that would be considered allowable. Letting agent or management fees. In most cases, this will be a flat percentage of the total rent received. The mistake that people make, though, is to declare their income after management fees have already been deducted, which means they are under declaring income and expenditure. So you just need to make sure that you declare the gross income and then the letting fees as an allowable expense. Legal fees. This is another one where you'll need to be careful of costs that are considered capital in nature, as these won't be allowable. For example, when you purchase a property, when you let it for the first time, or when you let it after it being empty for more than a year. The legal costs incurred in all of these situations would be considered capital in nature and therefore are not allowable. Any other legal costs in relation to the day-to-day letting of the property are considered allowable. Legal fees in relation to renewing a lease of less than 50 years, also allowable. Accountancy fees are another allowable expense, so if you engage with an accountant to produce rental accounts, the cost would be 100% allowable. Mobile and telephone costs. In most cases, landlords will simply use their existing private mobile contract to make property-related calls, to find tenants and to speak to letting agents. In this case, it's best to assign a percentage of your contract to the rental property. So if 50% of the usage relates to the rental properties, then you should assign 50% of the cost. Of course, if your rental business is big enough that it warrants its own mobile phone or landline that are used exclusively for this purpose, then those costs would be 100% allowable. Subscriptions to landlord associations, whether national or regional, can bring a host of benefits and are also allowable expenses. Advertising costs can be claimed. This would usually be advertising to find new tenants, however that's done, but typically it's newspaper ads and adverts on websites. Vehicle and fuel costs will be another common one for landlords. Using your privately owned vehicle to manage the property will usually mean you'll need to assign a percentage of the running costs to the property business, although there may also be situations where you need to hire a van or a vehicle for specific tasks, in which case those costs would be wholly allowable. Waste disposal costs, such as paying to have old appliances or furniture removed by a private contractor, these also make the list of allowable expenses. There you have 20 allowable expenses for landlords. Now, before we finish, I want to explain how mortgage interest works for residential landlords, because it's a question that comes up a lot and it's something that has changed fairly considerably in the recent past. Essentially, whether mortgage interest or other financing costs are considered an allowable expense will depend on the type of rental property you manage. If it's a furnished holiday let and you meet all of the criteria of being classed as a furnished holiday let, which are on screen now, then your financing costs, such as mortgage interest, will be wholly allowable, which keeps things very simple and means that you, as the landlord, will get tax relief at the highest rate of tax that you pay as an individual. If you earn enough to pay 40% tax, then for each £100 of mortgage interest that your rental business spends, you will save £40 of income tax. The situation for every other type of residential letting, which includes your traditional buy-to-let, is slightly different, but the impact can be significant. This is because for everyone else, mortgage interest is not an allowable expense, but instead, you'll usually be entitled to a tax reducer on the value of the mortgage interest spent. The big difference here is that the tax reducer is fixed at a rate of 20%, which is the basic rate of income tax in the UK. Now, for anyone who is a basic rate taxpayer, this has little or no impact, because even if mortgage interest was an allowable expense, like it used to be for all rental properties, you would have only been getting tax relief at 20% anyway, because that was the highest rate of income tax that you pay. But if you're a higher higher rate taxpayer paying 40% tax, then that's a big drop in the tax relief available, because previously, with mortgage interest being allowable, you would have been saving £40 of tax every £100 spent. Now, with the tax reducer in place, you're only getting £20 of tax relief. So it's the higher rate taxpayers who lost out the most with these changes. There are also a number of restrictions in place that will limit the value of the tax reducer and ensure that a loss cannot be created as a result. There you have it, 20 allowable expenses for landlords and a breakdown of how mortgage interest currently works. I hope you found that useful. Don't forget to check us out at gosimpleTax.com. Thank you for watching. See you next time.